The word bubble is often overused by us as traders and investors, but with Elon Musk's massive pay package being approved, and of course Cathie Wood coming back out again with some massive calls, including 3,100 over the next 5 years for the stock, are we entering into one once again? Well, one thing's for sure, we're in what we call a concentrated market. And in today's video, we break down again what's going on with the innovation movement called AI, as Broadcom goes up a further 12% in just the last 24 hours. Yes, it's clear that some stocks are doing amazingly well. Meanwhile, though, some of the biggest indices in the world are still showing signs of weakness, including the Dow Jones. So where are the next opportunities? Well, today we break down stocks, commodities, and cryptos together, including our thoughts on the current inflation figures. It's great to be back, guys. Let's get into it. This will be a good one. Well, welcome back everyone to The Daily Show. My name's Tom, and as always, we're discovering what's going on with markets, clearly looking at the macro, the data, the lead indicators, and the hottest charts. The last 24 hours, well, it was all about semiconductors, and it seems like that's really been the story of the week. If it's your first time here, remember to subscribe and smash that bell icon. It's great to have you here, and of course, let's get into where the biggest money flows have been going on right now. I think we'll start with our quick recap here of the inflation figures. And you've probably heard quite a few discussion points about this, but I think the big notable factor was, of course, that it was different from what most people expected. Most people thought it was going to be 0.3%. It ended up being 0.2%. And that ended up meaning that yields dropped and, of course, markets rose across the board, with risk on really becoming the big thing. Although that has changed a little bit over the last 24 hours. I think the most notable thing, though, was really that we continued to see some problems in things such as food and, of course, the big one, shelter. Now, we've been going on about this for ages, and shelter continues to remain a persistent, sticky problem in the markets. I actually posted over on X, so follow us if you're interested, that shelter was the main thing I'm looking at, and you'll see here how consistently problematic it has become. Now, this tends to be one of the most difficult things to get out of the inflation figures, and I believe that we shouldn't really be looking at month over month because we've already seen that narrative play out, and instead we should be looking at what's going on over the quarter. Regardless of this, though, the market loved it and they lapped it up, and of course they changed everything in terms of yield curves. In fact, you can see here the FedWatch tool basically went from no cuts anywhere this year to, we'll get into around 60 to 70% chance of cut as early as September, with some people now saying there's 2 rate cuts for the year. Meanwhile, if you actually have a look at the FOMC dot plot, which we get quite regularly, which I still don't know why they give us this, they really shouldn't, but anyway, they do, you'll notice that no one has any idea at the Fed. Take a look at 2025, and this is not the first time we've seen this. There are all over the place. There's people that believe there should be no rate cuts. There's people that believe we should be cutting all the way to 3, and that's a huge range for the Federal Reserve, and it doesn't really get any better in 2026. I would say there's mass confusion, and it's clear that they have no idea what the data figures are really going to be pointing towards either. Meanwhile, some people are trying to predict it. Of course, Bank of America here have a couple of claims, and they believe that we need to stay at around an average print of 0.19% moving forward to hit the Fed's latest forecast of 2.8% quarter 4 on quarter 4. So will that happen? Well, a lot of the metrics are still pointing to possibly reflation coming through due to stickiness that is there in the sheltered network, and of course, really services being such a hot area of the US markets. PPI on the same side, that also dropped off. And of course, this was a surprise. Headline PPI, of course, decreasing and leading to the markets to also further put pressure on the yields. So where does the Fed's fund rate futures look like right now? Well, it looks kind of like this. And you can see here with this chart how many times it's changed for us over the last 12 months. It's been a wild point. At one point, we were pricing in so many rate cuts that we'd basically be back all the way back to 3% by 2025. Now we're pricing in rate cuts as soon as kind of September, and then a moderate rate cutting period all the way through to kind of like a flat line around 4%. Now, remember, rate cut speed is such an important thing. We just saw the ECB, the European Union, do a rate cut, and they did it, with 1 rate cut. They're not doing it with 2 straight away. If you ever see a central bank do 2 rate cuts just like that, they're panicking, and you need to be starting to say, whoa, what are they seeing in the back end? Remember, the faster they go, the worse usually the crash or the impending doom of the markets could be. Meanwhile, to all of this, we're seeing these semiconductor stocks continuously doing very well, and Broadcom came out with some amazing revenue returns. AI revenue surged 280% year on year to 3.1 billion, offsetting weakness in other areas. And of course, they integrated their VMware acquisition, and basically across the board, we saw some pretty amazing returns. On the flip side of this, we also had, of course, Tesla's kind of shareholder meeting, and some of the key points here I thought were kind of funny because, of course, again, they're going big on the AI concept. Here we see the Optimus humanoid robot has the potential to be even bigger business than vehicles. So, of course, the transition to the AI business is the big thing here, possibly increasing Tesla's valuation by $20 to $25 trillion if scaled to produce 20 to 30 billion robots at $10,000 each with that 50% profit margin. This sounds like one of those Shark Tank kind of reports where you go in there and you claim how big the market sector could be and then claim you're going to take it all. Anyway, Elon believes there will be ultimately more Optimus robots than humans. And of course, they doubled down on more AI discussion, with Tesla's claiming that it is developing some of the world's most advanced AI chips and software for vehicles, robots, etc., etc., etc. So I think most businesses are going to be doing things like this over the next coming years, as we are in what I believe is the AI bubble, effectively a period of time where humans experiment on what is a very exciting new technology, and we continue to move forward with some pretty big strengths, you would have to say, in terms of where we're going to be projecting numbers. Now, is this wrong? Well, it's actually been done plenty of times in history. And we'll talk about Tesla and whether it's broken out, because of course, our interpretation of what's being said and what the market is doing in terms of flow is a very different thing. And we do have options coming up a little bit later on. But if you've missed some of our videos recently, what have we all been talking about? We've been talking about the concentration in the markets. And of course, you're seeing breadth becoming a big discussion point recently, and rightfully so. It's looking pretty nasty. But at the same time, concentrated markets have been a pretty common thing, and they've led into super bubbles. We saw it in the 60s, we saw it in the 1990s, and we're seeing it again. Basically, this was the .com. This was kind of a different market of infrastructure. And over here, we have the AI bubble. So as long as things like NVDA, Broadcom, and other semiconductors continue to drive the markets, although it looks unhealthy, you can see market leadership is not a new thing, especially in the US. In fact, here's a chart that goes over since the 2020 crash, and you can see here that for most of the period, market leadership of the top 10 stocks has been incredibly fierce. And this is because these stocks are also cash flow positive. So basically, we have cash flow positive, good cash businesses that are continuing to expand, that are continuing to gobble up the competition, and at one point will become the largest businesses, probably rivaling realistically, well, they already are rivaling countries' GDPs, and on top of that, they'll be probably even rivaling what's going on in the US. Now, is this normal? Yeah, it kind of is, and you can see here a bit of a breakdown of all the different main sectors, and you'll notice there are a couple of interesting things here. Of course, Bitcoin, number one, has been returning better than the market, which is to be expected. It's kind of like a penny stock in some ways in terms of the way it sometimes moves, although it is now expanding into a more broad market. And then we have Magnificent Seven stocks, we've got tech stocks, we've got FANG stocks, and we've got some kind of communication stocks doing the best. On top of this, we also have some standouts in the world markets, including European banks. And you might be asking yourself, how is that possible that European banks, during a time of high interest rates and supposedly tight credit, are doing so well? Well, let's just say the credit may not be as tight as some people think. And of course, they're flooding the markets with debt, and the markets are loving it. And we saw that in that last video. So go and check out our last video as well, where we broke down some of the big English banks and actually showed how the more you're riding at the moment, the more your stock is improving. And of course, if the market sees that, and especially if banks see that, what are they going to do? They're going to want to be lending more so they can increase their profits. So it's time now to see whether this also makes sense in the US. You might say, well, we had fixed interest. How is it that these banks are still doing so well? Well, a lot of it is because I don't even know how they're offering this, but they're actually offering bank deposit rates at 0.51% during a time when we're seeing yields well over 5%. This is wild to me. And this differential is giving huge bonuses to some of the biggest banks, basically borrowing money for 0.5% from us, the retail traders, And yeah, it seems to be still a thing that's going on around these markets. So as long as that's there, remember, that is why we're seeing such a huge increase in profits coming in across the board. Plus, of course, borrowings may be starting to get even wilder, which we'll talk about in the future, especially if certain things are approved in the US. Now, I thought this was an interesting one, adoption curves. This is a great chart here from Julian Trimmer over on X. And basically, he shows here some of the biggest things that we've seen over the last kind of, let's call it 200 years. And basically, we've had, of course, the railroad. We've had things like steel production, the Industrial Revolution. We've got VCRs. Remember Betamax? Anyone out there? Or laser discs, if you were old enough to remember that. Then we had, of course, the internet and mobile phones. And what you'll notice is that we got a lot of uptick. And you actually see this with all new technologies. You see kind of a normal kind of curve. And I thought this was a great chart because what it shows you, and really we need AI on here because, of course, AI is just at the beginning over here, is that we're seeing adoption following on Bitcoin and Ethereum at kind of similar rates to other technologies. Now, what tends to happen is we have this huge adoption, we have this experimentation phase, it turns into a super bubble, and then problems start to happen. And then, of course, it gets reborn in a whole new technology where it becomes the next great thing. And I do believe that at the moment, we are on curves like this in terms of adoption. So effectively, are we starting to see Bitcoin become more mature? Absolutely. And you can see here the adoption curve is pretty much right on track in terms of how Bitcoin is working, how Bitcoin's price is going through. Now, I think the same thing here is for AI. And what's occurring is we're getting that very exciting stage, which we saw on Bitcoin during that kind of 2012, 13, 14, 15, of course, going into the mania stage, which was the 17 run. And that was pretty monumental. Everyone started getting more, I guess you would say, knowledge on what Bitcoin and crypto is. So why does this all become important? Well, here's an interesting stat that you may not be aware of. 40% of the world's population is actually going to elections in 2024. And just remember, 2025 also has a lot of elections that will be stacked at the front of the year. Now, why is this important? Well, of course, this is political. Basically, nobody wants to lose, so they'll do whatever they can to keep in power. And a lot of that has to do with relaxing certain laws and letting certain things go on. This one here from Mike Zaccardi kind of shows how important 2024 is to stay strong, and probably some of 2025 as well. And that's why we're seeing things like central banks cutting. You're also seeing huge amounts of discrepancies between what's being said and what's, of course, going on around the world. Now let's move over to the breadth issue. Now, is this unusual? Well, you can see here that Grant Hawkridge over on X has shown that basically 40 to 60% of stocks are trading above their 50-day average, but that's starting to not look as healthy. I mean, we're at all-time highs, and we're not really seeing 60 to 80 or 80 to 100% like you would during a more healthy bull run. So the recent pickup, especially the one through that kind of April period into where we are right now, is not being driven by the broader market. It's being driven mostly by semiconductor stocks. Now, is that unusual? Well, no, we saw it back over here. And of course, we've seen it during many, many points here on the chart where we had a start which came off with semiconductors. And I think the important thing is here that effectively what we need to start seeing in the future is a little bit more of the green and a broader base recovery. It's not unusual to see it at the beginning of a new rally, but it is unusual to see it hold up for too long, of course, most notably over here. Now, during the dot-com bubble, it became incredibly concentrated, and I do think that we're entering into periods such as that. Let's have a look at the S&P 500 in terms of extreme overbought versus oversold. And you'll notice here again, we're seeing core models, that is that the rest of the market is not coming with the same thing. Now, we've had plenty of other periods such as this, some of the most notable ones over here, where we saw core models, of course, reduce, but at the same time, guess what happened? The market still started to drive higher. So basically, it usually is a sign that you're in that kind of final stage period, which can last for quite a long period. And in fact, when we went through and looked at the history, and I've got a chart on history coming up, you may notice that it's very normal when a new bull market starts, and we can argue that started in October of 2022, for it to outlast or go longer than most people expect. Here's one of the reasons why, of course, it's the buyback era. Every stock not doing well. Don't worry, guys. We're buybacking our own stock position. So, of course, continue to look out for that. and continue to start watching for IPOs as well. I think 2025 and the back end of 2024 could bring some new IPOs. Similar to what we saw in 2020 and 2021, IPOs should hopefully start to make a comeback as people feel euphoric about the markets. Secular bull markets, they tend to last a while. This was taken from a few weeks ago. And just remember, at this point, if we're entering into periods such as we've discussed already today, the 60s or the 2000s, again, I do not think we're in the 1929 narrative. Of course, we'll see whether that upgrades, but I don't think we're in that narrative. Then we have a little bit more room to grow and a little bit more room to go through. So let's have a look now at how things have been performing. Well, the last 24 hours was a mixture. We had semis, technology, and strangely enough, a little bit of a move into defensive. So here we go, utilities, staples, and of course, one of the other markets that we've started to see improve recently, which has been the consumer discretionary market. Now, that had been getting hit for quite some time, and it broke out again from its base, which we'll look at later on. And we kind of suspected this just ahead of the CPI. And then, of course, the CPI kind of confirmed that it was doing better. When we look at the last 5 days, again, look at consumer discretionary. It's been rotating into sneakily behind closed doors. Semiconductors doing well, technology doing well. And nice to see this one as well. Another healthy sign for markets to get the home construction back on top over a 5-day rotation. What suffered? Metals, gold, and many other things. Now, this is probably the pullback that metals and gold needed. And it's starting to get down to some very interesting levels, which we've been talking about. And one of the reasons is it became a concentrated trade. Everyone loved metals only a few weeks ago. Remember when we first started talking about them months ago, no one liked them. In fact, people were saying gold sucks. And I'm sure they're starting to say gold sucks again. And that's the time where you start thinking about, well, is this really, a currency war? Are we in this type of situation where we've got plenty of central banks around the world trying to get the main currency of the world if possible? And I think we are at that point. Let's now have a look at the S&P 500. I've got a weekly chart on here, and you'll notice, of course, this advanced decline line continues to go down. What is that telling us? It's saying breadth is weakening as we're making new highs. It is, of course, a caution sign for markets, but it is not necessarily just, go short because of breadth being so weak or anything like that. Now, if we look at Delta positive, you can see it's another green week that's probably going to close. And in terms of footprints, that is one of the things that we are looking at the moment. We want to see some nice positives here. Last 24 hours, how did it look? Again, these are technically positive lines as we gapped up, but we will be continuing to watch more the futures and the option situation. So here's a breakdown of what we're seeing in terms of the chart. First up, is it in a bull trend? Yes, it continues to be in a bull trend, and it continues to be above most of the options. So what we're seeing right now, especially if it can hold here into June OPEX, which is next week, is we're seeing a very positive gamma market that continues to go higher, and that means the dealer book is having to hedge to the positive side. So basically, it's like that self-fulfilling prophecy that we've seen a lot of 2024. The higher we go, the more it gets pressured by the options market, which is filled with calls to possibly pressure things such as 5,500. For the Friday move, we've got the expected one-day moves of the actual options market. 68% of the time, the market will be around these kind of levels. And if we do end up getting a pullback, I would think that the first buy zone will be around 53.55, which just so happens to be the most traded level within this range. So for now, it's higher highs and higher lows. Another one you could watch is 53.80, but I'm not seeing any signs of significant weakness on this chart just yet. And the main reason is, of course, this. Have a look at all of those calls. We've got 53.75 next week being one of the big put levels, and you can see it is quite stacked with puts. So again, if the markets hold up, this is just another basing structure. And if we keep pushing through here, look how much hedging would need to be done through the Friday and through, of course, next week, because effectively this just means the markets are going to keep pushing higher. Take a look at this as well. The 21st, the June OPEX next week, 5,400 remains the top strike. So if we keep holding above 5,400 throughout the week, more and more and more hedging will need to occur. 5,500 becoming the next big one. And of course, all of this will need to be watched day by day by day if you're interested in day trading it. S&P CTAs, what are they doing? Slowly buying up, still quite neutral. Nasdaq's the same, quite neutral, but purchasing still. And when we move over to gold, you can see they're still on the decline, while Brent and crude have increased. So we've actually had them buy back in as we dropped off to our key big positional investment level and then rallied straight into the most traded zone, which we'll look at very, very soon. Some great little trade zones have started to appear through quite a few markets, and I'm looking forward to going through them together right now. Let's have a look at NVDA. NVDA, of course, another positive gamma candidate sitting right on 130. It would probably do well just to sit here for the Friday close. You'll notice that is going to be quite profitable. You would assume these are mostly rights from retail traders, and I'm sure Wall Street would not mind to be making that money. So if they can hold it below 130, I'm probably pretty clear they would like to keep it there. When we move forward to next week's OPEX, again, 130 is the big strike level. If NVIDIA does break through and up, it's going to possibly move to 140. Why? That's the next logical zone, and we have a huge positive gamma situation. Look how much positive gamma there is. It's across the board throughout pretty much every semiconductor stock at this stage. Speaking of positive gamma, have we just entered into Tesla? Regardless of what we might think about whether that AI call is real or not, whatever it was, 20 to 25 trillion, sure, maybe, but not right now, I don't think. Then we can have a look at the price action. And what you'll notice is coming into Friday, it is actually skewed towards the positive side, especially a break and movement above 185 would need to be probably dealer hedged. And this would expose 190 and, of course, maybe even expose 200 next week into the OPEX. So you'll notice that as long as the market, especially if it closes this weekly above 182.50, that'll be a huge deal. 182.50, 185 is where we've seen so many call strikes. And because we've been coiled for quite some time, especially with the breakout over the last 2 days that we'll watch, this is a big deal for Tesla hodlers. And Tesla hodlers will want to be looking for those breakouts next week. So, of course, stay tuned for that. So I thought this was a really interesting chart. Basically, it just shows you when you start a new bull market, how many months on average you can expect that bull market to run. Generally speaking, 61 is the average. And in recent times, we've seen a couple of just kind of 20s, which is where we are right now. But we've also seen some monsters. I would say we are probably somewhere in this kind of 30 to 60 range this time around. It makes the most amount of sense. And I doubt we're going back into these monster bull market runs that are between 114 and 131. So something to keep an eye on as we enter throughout 2024 if we continue to see the markets rally, which I guess we may continue to see so. Let's have a look now whether we've got internal weakness moving forward over the next couple of days. Well, first up, options market and bonds. That's actually dropped through the floor after CPI. So no real risk there. Over the US 2-year, we saw stabilization. And if that closes the weekly above 4.7, I think regardless of the CPI number, it's really still trapped within the overall kind of 2-year range. Again, the shelter is concerning. What do you guys think, though, down below? Are you just like, no, this is the time we're going to get cuts, like that narrative earlier in the year? Or do you still think that the Federal Reserve won't give a cut? Now we move over to treasuries. Of course, they're expecting some cuts or at least weakness in the future because we're seeing them rise back through. And as we've talked about, treasuries have been in a very good state. Around 88 to 92, I kind of like that on the longer term. Now, if you've got a 1 to 2 year horizon, I think it's kind of exciting because we will eventually get cuts. They're champing at the bit to do it because they love supporting the economy. So, of course, if they can do that, they will do that. And at the moment, you'll notice that we've got some key breakouts, especially if treasuries manages to hold here. You've got to think of this rejection and this strength here as basically being like a long leg doji. So really, we're coming out of potentially indecision if that occurs. And when you look at it with the 10-year rate and the 20-year rate, you'll notice that they've actually weakened to a greater degree. Again, weekly closures will be important. But versus the 2-year, they're actually starting to break down. Now let's move over to ITB, home construction, as we said, held up. Not bad. That's good. DJT was actually a bit weaker. And central bank support seems to be kind of looking okay. Some notables I will also say on the S&P is that you'll note it gapped up here and it sat here for 2 days. Now, just like anything, like what we've been talking about in NVIDIA, if we do get a gap down, that is an island reversal, and that's only if it does happen. And that is actually a decent bear sign for at least some internal weakness for a couple of sessions. Now, if that ends up happening, sure, you'll also notice we've got some kind of heavy reads here on exhaustion. So these are early warning signs, things that you can look at. But remember, the price action on the futures anyway has been quite bullish. So gap down, certainly a little bit different. That would be a shock to the markets. But for now, they keep driving higher. They're trying to get that 5,500. Let's move over to the US dollar. Now, this was a really interesting trade. It pulled back into this structure here and then instantly found a buyer. Now, we sold off the area we thought we would. In fact, that was a pretty good sell leading into the CPI number. Then the PPI pushed it back through. And it's like, well, is it risk on? Is it risk off? What the hell's going on here? And I think the market is very confused. So really, the weekly will need to be paid attention to. If you are bullish on the dollar, if it closes like this, especially if it then makes a new high next week, that could be really significant and actually could push the dollar not only back above 105.50, but it may be even higher. For now, I'm going to see how the Friday closes through. I think the weekly is very important here on the charts. And obviously last week was super bullish looking. This week, well, time will tell. Let's see how it ends up closing. It seems to be having a lot of problems picking its next direction because this is a super critical level for the dollar. Meanwhile, that means that things like copper are struggling around that watch reaction here. Again, 450, such an important point for copper. And it means that we've also got gold sitting around its important point as well. And its most traded zone, it's sold off, it's brought back down. And what I would love to see actually is a wipe. So I'd like to see gold go weaker, then stronger, and then actually really push through. Another possible scenario is a weekly close below this key level here of 22.76. And unless that instantly bites back and gets strong, it's really starting to point towards 21.60. Now, a lot of people have been asking me, Tom, are you changing your opinion on gold? Do you still think gold's going to hit 3,000? I personally do. I just think that the Chinese central bank stopped purchasing it so that they could manipulate price. They've been doing this a little bit on metals recently, copper, iron ore, a few others, of course, purchasing huge amounts, getting towards a zone, then dropping, and then, of course, hurting the prices. And it's all, why wouldn't you? If you want to get cheaper price, you're going to start to do this, make announcements, push markets down, get cheaper price, etc. I think once they started buying the way they have, they're probably not going to stop purchasing because it's in their best interest to also push the price higher. But as you'll notice, long term that is, but as you'll notice, this will become a key level. So for gold traders, some people are going to like it right here because it's basically a 61.8 pullback of that movement up. I'm looking for a little bit more information. So we're still waiting for good base and it's starting to form. Now, what about silver? Well, silver actually gave a false break to the upside. So that was the 29.87. It failed to stick that, as in failed to really hold that level on any significant time frame. And it's continuing that weakness that we saw in the weekly. And this is why weekly positioning is so important. You can see here the big rejection, the second rejection, and it looks like it's trying towards that 27.90 zone. So keep watching on silver. We haven't seen a turn yet, unfortunately, for that particular metal. What about US oil? Well, it's coiling around the most traded zone. Now, this is exactly where you would expect to find some weakness, right around in here. And because it's coiling, if it does manage to break to a new high here, there's a good chance it's going to break out 80.50 and then keep moving forward. Something like 84.50 to 86 becomes real possibility at that stage. I'd love it to come back down to around this point here, which would be around the price of 75.30. I just think that would be a pretty cool technical run. And that would basically mean at this stage, it looks like the buyers are back in. And why? Well, hedges have been under invested in this, and quite a few other people have probably dipped out of the oil market and they'll want to get back in, especially if the market gets above 80.50 a barrel. Watch Brent as well. That will be important. Let's move over to the stocks of the world. And of course, we'll start here with Tesla, which did the classic sign of a nice big rally. And that rally, of course, pushed through some massive options over the last 24 hours. The big thing here was Tesla went down to our previously, big zone. Of course, we were looking at 170 being a huge zone of buyers. And then it kind of dipped and then rallied back up, closing the next day strong, which was a good sign. And then, of course, gapping right into the market. Now, it managed not to hold throughout the session, but I do think anywhere around this gap fill here, there will be some people trying to get back into Tesla. And as long as it holds the weekly, because, of course, the weekly will want to close above this 20 moving average, above 183.45 would be good. Even above 182.50 would be good on a weekly. This may be the break that we've been looking for. And, of course, it does come with that old head and shoulders, I guess, which is here. Left shoulder, head, right shoulder on the smaller time frames. And if that was proven correct, people would be getting quite excited about Tesla. Though you can't really like Kathy Wood saying that she believes it's worth so much, and everything she touches recently has not turned to gold. It's gone kind of bad. Let's move over to NVDA now, and that keeps grinding higher, similar to AVGO, basically just very strong trends pushing away from the 20 moving average. So mean reversion's really behind these. And eventually you're going to get pullbacks to mean reversion. It's always the way it is. But for now, you're looking for signs of exhaustion. And we just don't have enough of those signs yet for something like NVIDIA. So post-stock split, it still continues to perform well. Remember, the general rule has been around 1 to 3 days, which I think we're on right now, about 3 days. That's where you start to see the weakness. But we haven't got one in the charts just yet. One of the things we could look at is footprints in the market to see whether NVIDIA is actually net delta selling. And if you have a look here, there was a little bit of selling, but of course that's not new and it's not in a big quantity. There was a massive one over here on Thursday with people preempting it. But yeah, net delta selling maybe over a week could be something that we start to watch here. Let's move over to consumer discretionary versus staples. And this has broken up. We kind of suspected it the other day that we might be seeing things like just shop. Obviously, we've loved Hood recently, although that's not consumer discretionary, but we're seeing these types of stocks start to pick back up. And yeah, they've been doing quite nicely on the charts, not too bad in terms of breakouts. Another one that's interesting to watch is this, which is Tencent Holdings. Of course, in China, the market has been getting pulled back after everyone jumped on board. We were discussing it much before then, but I'm starting to like some of the things in terms of the pullbacks we're starting to get. Tencent will be the one I'm watching. Similar to NVIDIA in the US, we look towards the leaders of the market to drive us up. And Tencent is at that important point. HSI, not quite showing the real signs of super strength yet. We're not even through 18.2. But if we get through 18.2 and then eventually get through this, that would be a really great sign that the Chinese market is starting to improve again. At the moment, I'd say it's a bit stagnant at these levels. Aussie 200, very stagnant as well. You'll notice that the weekly continues to hold above this red line, which is the 20 moving average. So for the Australians out there, as we enter into indices here, it's still holding up, but we do need to see a new high. You don't want a new low. That would signal a rollover of this market. And of course, we would probably rather not see that just yet. Some of you would rather see it, I'm sure. What about the Dow? Let's move to the US market. So the Dow is very different from the semiconductors and therefore the US 500 or the NASDAQ. It's still weak. In fact, we talked about this supply, and for shorters, you're probably pretty happy with yourself thinking, yeah, that's right, I shorted this market and it's going down. For long people, you really need to see 38.4 hold up. If the Dow fails here, it could be going to a new low on this chart. And of course, there will be quite a lot of positions short here. So if the market is able to break through 39,250, close above that, I could see a squeeze starting, and that would probably improve breadth across the board. So the Dow is well worth watching. Also, the US 2000 is worth watching. We had the tweezer trade, which was here. And for anyone that managed to get onto that with some buy stops, and I like to always take a tweezer when it breaks to the upside. And usually I prefer to look at the confirmation as well and see if the risk reward makes sense after that. This was a pretty sweet trade actually on the CPI. Now it's pulled back since that point, selling off this supply that's up here. And we're back to the most traded level, the first buy zone, one of the most important levels here. So it's very important that the US 2K finds bid, I would say, over the next 24 hours. And when we look at the next structure zone, you'll notice that there's some hideous looking candles in here. You've got this big rejection after it finds bid just around here. Then it's come down. Now it's building. I'd like to see someone buy in around this 2020 zone to 2030 zone because it really needs to hold here. But what do you think? Do you reckon the Russell 2K can hold? It does have signs of strength coming off those tweezers, but must hold here. So this is where the bulls will be clearly watching the US 2K. And then there's the NASDAQ just driving higher. Starting to get near exhaustion phase, similar to what we saw before, but we're not quite on massive exhaustion yet. So that still pushes higher. Let's move over to the crypto world. So while Ethereum's given up a little bit of gain, so has Bitcoin. But Bitcoin did have, so close to serious positivity. And just shows you why you've got to have the right levels. 70,200. I'm telling you, if Bitcoin had got above this level after doing what it did the other day, which I suspected it might, that was going to be, I think, a really sweet position. It didn't do it. It ended up just kind of weakening off here, and we're back down to this zone. So you really need buyers to hold between 64.5 and where it is right now. If it fails underneath here, we could be going all the way back into the 50s. So very important that Bitcoin holds around this zone. And again, I want to see a 70,250 break close to really signify that all of this coiling that's going on right now will hold up. You know, even something like this right now, that would be such a strong signal. So I'm really excited about the Bitcoin chart. I know it doesn't look like the one, but I do think that there's usually a pretty good trade coming up when you start to see these types of things. So obviously we've had the CPI now, we've had the federal FOMC statement press conference, and they have no idea what's going on. Of course, Jerome Powell saying the same real thing always. Core PPI came out, that was weaker than expected. And now we go into the Bank of Japan policy statement. Now this could be quite important, especially if they get rid of their yield control stuff. Ultimately, it's going to be one of those events that you'll have to see play out, hard to predict. So better to sit there and, of course, place positions based on your stats, based on your replication and everything else. If you enjoyed today's video, remember to subscribe. It's great to be back, guys, and thank you so much for watching and bearing with us this week. And, of course, if you're interested, follow us on some of the other socials, including our X account. It's always great to see you there and to interact with you in the comments. Thanks so much, everyone. Bye for now.